Well, with stocks setting a record high, some titans of the industry are taking a cautious tone heading into the end of the year as well. We heard from a bunch of them throughout the day here on CNBC. Here's what they said.
We've been at a peak for a while, and I just don't know how much longer this can continue. But we've been saying it's at a peak for a couple of years now, and we've been wrong because it keeps going higher.
There are a lot of valuable companies. Rates are very low. You know, it looks like the stock markets are forecasting a pretty rosy outcome, and the bond market, it's hard to say what is forecasted because it's a lot of bonds being bought by central banks.
Investors are very flush with money, and as a result, they're taking very low returns, and they also are buying dreams rather than earnings in stocks.
Our next guest is also on alert, predicting a pullback will rattle the market between now and December, but he views it as a significant buying opportunity. Tony Dwyer is chief market strategist at Canaccord Genuity. Tony, welcome back.
Hey, thanks for having me, Mel.
A pullback of 2 to 5% this month. That doesn't seem so bad.
Nobody watching the show is expecting me to come on at a new record high, being the bull, and
you're the bull. You're the bull guy.
What I'd like to do is put data to what everybody on the desk is saying. How do you know when a pullback is coming? So we found that when the S&P 500 is up more than 20% for year-to-date through the end of October, it's always up through the end of the year by a median 5%, greater than 5%. But 5 out of the 7 occurrences, you could buy it cheaper than the October 31st print. So if the market's up 1.5% or 2% from there, and you're worse, you could have a 2 to 5% pullback over the next few weeks. You add to that my buddy Jason Gofford at Sentiment Trader found that when the S&P, the Dow, and the NASDAQ make a record for all together on the same day for the first time in over 3 months, you typically get a 75% odds of a pullback over 2 weeks by just under 1%. So I'm not calling for any kind of monster pullback. And people are going to say 2%, 5%, who cares? Why trade it?
Why do you trade
Because
that?
down 2%, everybody's freaking out. We're doing a CNBC special.
Like, easy.
The threshold is like 3%. Let's get that straight.
Usually I'm on it, so I get it. But no, seriously, I mean, everybody down 2% thinks it's going to become 7 to 10%, and they don't buy it. So my message wouldn't be trim. My message would be, if you're about to get in because you're making a new high, you don't have to chase the next tick. You can wait a little bit.
So just wait. Okay.
All right, but down 2% is a lot of sort of flat, and then some down, big, like 10%.
Sure.
So when you see a down 2%, would you say, all right, time to start buying those ones that really got hit, the down 10%?
I would. I would, Karen. And I'm kind of in your institutional fund manager. You can't buy the low tick. Anybody that comes on here and says they're going to buy the right exact percentage, I think, is delusional. I know I can't do it. What I can do, though, is know why I'm buying. And that way, when it does go down, it's hard, but at least I'm able to add into the weakness. If I'm not convicted before it comes down and expect a pullback, there's no way I'm buying down 2 to 5% because it could be 10 to 15. And that's why I'm so fundamentally convicted.
If you were waiting to buy, what do you buy when you're down 2 to 5%? Are you buying the sectors that got hit the most in that pullback down 2 to 5%?
I'm buying offense, and I've been buying offense. So the guys printing the money, I can't yell it loud enough. The guys printing the money gave us the game plan globally. I can't say it emphatically enough. Last week, Powell said an amazing thing that people didn't, I don't believe, pay enough attention to. He said the only thing that would make him raise rates is meaningful increase in inflation above. Everybody knows that part. But he also said early next year he's coming out, the Fed is coming out with a way to get inflation expectation higher. Are you going to? That's not tightening. That's adding liquidity somehow, or making asset prices go up, or some way of creating more spending. You couple that with a comment, Mel, that he said that earlier this year they thought low inflation was transitory, and it wasn't. He just announced the generational change in Fed thinking on inflation that we talked about in July, where they're more worried about deflation than inflation. It's a generational change. So what does that mean? Fed put 101, higher valuations, and even now, given the turn in the global data that Timmy outlined, and the manufacturing PMIs, not that they're good, they're less bad. Let's say you actually turn the global data and stabilize it, make it a little bit better. The consumer in the U.S. is benefiting from the lower rates and easier Fed. You could have what we've talked about the whole year, a mid-90s kind of environment, a post-95 environment, where you get big drops, but 20% kind of years.
Didn't he come on here as bearish? Everything I just heard was.
He's like.
No.
He's buying I'm being cute.
I know.
And so
if I don't convince you ahead of time, Timmy, you know that we're not buying the weakness. If I'm not convincing you ahead of time, you're not buying the weakness. I want to buy the weakness.
So fundamentally, because you said, I'm looking at this fundamentally, and you're talking about a couple triggers. What is that downward trigger? Is this a trade? Is it a trade headline? I mean, what's going to move this? Because what I'm hearing is sentiment. What I'm hearing is positioning. What I'm hearing is tactical timing in the calendar and a history. But what's the fundamental trigger?
Down 7% October 2nd with the market collapsing. There's no trigger for the downside. We're in it. It could be it could be a trade headline. It could be a Fed comment. It could be an earnings statement. It could be really anything. There's no identifiable. We're positioned for it, meaning we're set up for a news item out of nowhere.
Tony, good to see you. Thank you.
Thank you, Mel.
Tony Dwyer. Feels like a bull with little bear ears on.
He has difficulty, and he's been largely right with his bull call.
Exactly.
So you can understand why he wants to dance with the bull that brung him.
So you know, the most important thing you said was about the Fed, and when you interpret the Fed, everyone worries about whether it's a hawkish cut, a dovish cut. It seems like the dove is leading the FOMC, and that's the way it's going to stay. And once market participants get it, it's off to the races for this market.